Because clearly not all this was in the data. So how would a quant firm, do they take in the fact that maybe Europe's the place to go and they start rolling into it, or that country risk is all of a sudden very different? The US isn't the prettiest equity in the block and they should all of a sudden dive into Europe on Tuesday because it's better? How does a quant firm allocate in such a time of turbulence?
Great question. And it's going to take me a minute to answer. So
All right.
I think, first of all, we're going to talk about, multi-strategy, large quants that are invested across regions, first of all, or else they can't do that. And then, you know, there is natural rotation among, maybe organic rotation among factors and regions based on returns and risk. Like you usually follow good returns, and then you kind of take down risk when it rises and you're losing money. So I think the answer is, you're going to dial down risk in the U.S. because volatility is way up and returns are down. So sort of by definition, these aren't things that are predicted by historical relationships that you're going to be betting on with the majority of your models. And then quants don't really have a toggle that says, like, let's shift out of the US and into Europe. That happens more naturally, just based on returns and risk.
Mm-hmm.